everyone. Welcome. So Wednesday, 6th of March. So today, as you might already realize, we're gonna go through two technical indicators that are more precisely a bit more. You can see them quite rarely. I mean. They are not so widely used, at least for the majority of the traders. However, they are quite useful, especially for momentum failures and for facing when you're facing extreme trading conditions such as overbought and oversold situations. So today is all about CCI indicator and Williams percentage R range. So as usual, before I start the session and we got going through the slides, I need to go through the disclaimer warning. And please, I will really appreciate the feedback regarding the audio, and of course whether you have received my slides in the handout section and whether you can see my screen as well. So a feedback will be more than appreciated. Thank you very much, Rotero. So these materials provide this general marketing communication for information purposes only and does not constitute an independent investment research. Nothing in this communication contains or should be considered as containing an investment advice or an investment recommendation or a solicitation for the purpose of buying or selling of any financial instrument. All information provided is gathered from reputable sources, and any information containing an indication of past performance is not guarantee or reliable indicator of future performance. Users acknowledge that any investment in leveraged products is characterized by a certain degree of uncertainty and that any investment of this nature involves a high level of risk, for which the users are solely responsible and liable. We assume no liability for any loss arising from any investment made based on the information provided in this communication. This communication must not be reproduced or further distributed without our prior written permission. Trading leveraged products such as forex and derivatives may not be suitable for all investors as they carry a high degree of risk to your capital. Please ensure that you fully understand the risk involved, take into account your investment objectives and level of experience before trading. And if necessary, seek independent advice. You can find our full risk disclosure on the website along with any legal documentation that you might need. Feel free to visit the website or contact the support team for anything you need. Once again, this is our email address. Feel free to ask anything you want. Support team and analysis team are handling this email, and we reply within 24 hours for anything you need regarding technicals, regarding fundamentals, anything you need. We are here to help. So, as I already mentioned, today we're gonna go through these two alternative, let's say, indicators: commodity channel index and Williams percentage R range. Just a quick reminder, because I saw a question just now. This webinar is being recorded as usual, so if you cannot stay until the end of it, you will anyway receive the recording via email. So you can find both indicators in MT4 and MT5. And also, please bear in mind that these two are oscillators, okay? So as you understand, they tend to be best in ranging market, exactly because they are oscillators. We're gonna have a look on how they look like. We're gonna see a lot of examples together, etc. But have in mind that always, if we're referring to oscillators, have in mind that we are referring. Actually, they tend to best work in ranging markets, but also if you hear the word oscillator, that means that they have some particular boundaries. Okay, we're gonna have a look in a bit. Let's start with the CCI, Commodity Channel Index. Okay, obviously, when you hear the name, you consider that it might be solely used for commodities. That's no longer the case. Okay, so despite its name, the CCI can be used in many markets and in multiple time frames. Okay, it was initially indeed developed for commodities. It was developed actually by a technical analyst, Donald Labert. However, later on, the traders adapted for across actually the market and for multiple time frames. So its initial purpose, as I said, it was mainly for commodity market and for spotting long-term trend changes. But over the years, it has been proven very, very useful for other assets and across the markets, as I already mentioned, and for multi-time frame as well. So so it has been actually established. It has been established for both long and short-term chart, but with different usage. Let's say so traders that use the CCI on the long-term chart. They tend to use it for establishing the dominant trend, while the short-term or intraday traders tend to focus on pullbacks or to generate any trade signals. Okay, so let's firstly let's start a bit with how it looks like, how is it calculated, and what these boundaries, where these boundaries are, and etc. So you can see the formula. I've put it on. You don't necessarily need to remember it or calculate anything. Anyway, the MetaTrader will provide you automatically the CCI chart, okay, the CCI line chart. So this is just the math behind the indicator. That's pretty much it. So the CCI indicator looks like that. Here you are. It reminds you a bit of RSI. Here it is, okay? It's a line with barriers, with a center line, okay? So I'm gonna come to that in a bit. Okay, here we are. So it's very crucial, this boundary, actually, but this range, the values, to be more precise, the values of CCI is what helps us identify either the emerging of new trend, either some extreme condition, okay, or even a potential divergence. Actually a divergence, which means that potentially we might see the shift of the trend. So as you can notice from the formula, What CCI presents and what it measures is basically the difference between the asset's price change and its average price range. So the typical price, okay, the typical price change and its average. So any high reading, any high positive reading to be more precise, suggests that the prices are well above their average. Okay, so what that means? Does anyone can anyone tell me what that means? When we can have spotted that there is a high positive rating in CCI, which, as I mentioned, indicates that the prices are well above their average. So if we see something like that, what that's supposed to mean? Yes, Rodero, well done. Yes, Rodero, reply uptrend. Yes, it shows strength. Okay, strength. Let's stick on that. While lower than average values and even precisely negative ones, they present weakness. At this point, I should mention that the CCI indicator can be used as either a leading indicator or a coincident one, okay? So, what these values reflect, okay? As basically how this indicator works. So, by default, or at least the typical interpretation of CCI is that when the CCI values are above 100, okay, that reflects a pretty strong price action. So basically, it theoretical. Okay, I'm gonna come to that in a bit, and that signals an uptrend. However, it could also suggest a potential downwards reversal. You can say, but how is this possible? It is possible because before applying CCI indicator in your chart, you need to make sure that the settings satisfy your asset. Because there are assets in which we can see an above 100 value indicating the beginning of an uptrend, okay, while there are others in which we should change the range of the CCI, because a move above 100 could indicate that it's already overbought and is already ready to reverse. Okay, but typically, the 100 is considered to be similar to RSI, which we have the 80, above 80 is an overbought condition. So similar is the 100 for CCI, while values below 100 suggest oversold conditions, so suggest a potential upwards reversal. So as I already mentioned, there are assets, there are instruments that due to their extreme volatility, we need to change the range of the CCI. We need to change it to plus 200 or minus 200 and etc. So you need to make sure that the default settings actually satisfy the instrument that you have applied it on. So don't worry about it, about the settings for the time being. We're gonna see many examples, and everything will be straightforward. So as I already mentioned, it's typically is used from long-term traders. in order to, if there is a predominant trend to a certain, let's say, the prevailing trend. But if but it can also be used from shorter traders, intraday traders, scalpers, even scalpers, sorry, in signaling out pullbacks, and even it can be used for entry or exit points, to identify exit and entry points. So you can use it for spotting a new emerging trend, as a signal of a new emerging trend. You can use it for identifying overbought and overstock conditions, and you can use it for identifying a bullish and a bearish divergence. Okay, so let's see together how it can be used for signaling, for spotting, let's say, new trend. So, as I mentioned, the typical and the by default movements are between -100 and +100. By default, Davidson, it will be -200, but there are some cases in which an asset is more volatile than others. So in this case, you might need to change it. Okay, how you can change it, how you can identify that it requires an adjustment. Check the historical data to check the past performance to see whether the -100 and 100 indicates a reasonable signals for that particular asset. So as I said, by default, it moves between -100 and +100. So as you might have already understood, a move that exceeds this range shows either a strength, an unusual strength, or an unusual weakness that we can use as it could actually is a sign of a shift in the trend. So basically, these levels actually are filters for bullish and bearish momentum. Now, okay, so as the main principle behind CCI is that values from negative or near zero levels to above 100 indicate the initiation of an uptrend, while on the flip side, it emerges a downtrend if we see indicator turning from positive or near zero to below -100. Okay, so that suggests the onset of downtrend, and you can obviously be used as a potential selling signal, potential bearish signal. So I mentioned the zero reading, right? So similar with RSI, okay, in RSI, the midline is the 50 level. So, but the mentality behind it is very, very similar. So the zero line, okay, it's very useful for identify entry levels, okay? It occasionally could lag a bit, but in general, it could be used if it combines, if you combine it, of course, with price action analysis, it could provide a nice entry point levels. So let's focus on this example over here, okay? Let's focus on that one. So let's see it together. As you can see over here, I have a euro dollar chart. Okay, so let me focus on that. So as you can see, we have found actually a zero level for CCI. Okay, the mid, let's say, the mid of the range. And as you can see over here, after a sharp decline of the euro dollar, we have seen that the asset steady for many consecutive sessions. And during this consolidation over here, okay, this actually is more than 20 sessions, for more than 20 sessions, it was consolidating at the bottom of the trend. Meanwhile, the CCI indicator, which was close to minus 200, so it was oversold, it started rising, retesting the center of the range, so the zero line, until it managed to cross above it over here. Look at that. And with a very sharp slope. So be careful about the slope as well, the slope of the CCI. This indication, so the move and the cross above zero, it was combined with a break. Let me just, I'd like to draw a line so you can see it. It was combined with the break of the immediate resistance level that we have seen here. So when I mentioned that it was consolidating for more than 20 sessions, you can see that I was keep retesting this area again and again, and it managed to break it eventually here. Here, it was the very first time that it didn't only retest it, but actually managed to break it and close above it. And just 3 sessions earlier, we had also a move above zero for CCI. So that was one possible entry level to the upside in a long position for this euro dollar example over here. Another possible entry, is the retracement over here. Why? Because after this correction to the downside, look at that, it managed to hold at the same level in which it used to actually this level used to be resistance, right? Now it turned into support. So there was a bit of a correction, but it held gains above it. Okay, so this is a retracement signal. And it's not only that, the retracement signal on the actual price action, but also on the CCI indicator, because look at that. It came down, retested zero level, and rebound. So it held a move above zero and rebound, and we've seen a rebound and retracement in the CCI indicator as well. So it didn't turn negative. So a combination of the CCI retracement in combination with the price action retracement was another buying signal, because it was actually it was a signal indicating that this uptrend has not run out of steam. It was just a correction and it could extend further to the upside. Yes, Yvonne. Yvonne, don't worry about it. Anyway, you have the slides. So if that helps. And I have a better examples in a bit. So let's move on to the next one. And I will zoom in this one. Just a second. Actually, yeah, let me zoom in here. So here is another example. I think that's a much better one. So here is an intraday. It's an intraday example, pound Swiss in 1 hour chart. And there is, we combine the CCI. Actually, we have enabled in the CCI indicator, other than the line chart, also the histogram of CCI. This is up to you. If you prefer to have just the line, similar to RSI, that's fair enough. If you prefer to see also the histogram, feel free as well. It's up to you. So what we have over here, we have seen that the pound Swiss was down to 131.50 territory, with CCI being negative, being below zero. However, the CCI started improving, started increasing to the upside, started turning closer to zero, in line, actually in a line with the price action, until it managed to cross above it, okay, cross above it, and managed to move, as you can see, to break the previous high. You see, I haven't really focused over here on the actual values of CCI. I mean, 100, minus 100, 200, minus 200, etc. We were just monitoring the behavior and its and any pullback or break of previous highs from on the actual CCI indicator. So this cross, the sharp slope, along with the cross above the previous low, and the fact that it crossed above zero, in combination with 1, 2, 3, 4 consecutive bullish candles in the price action, it was an indication that there is an increasing bullish bias. Okay, so it was the very initial signal that we might have a new trend to the upside. Okay, so and as you can see, it took a while, really, right? It took a while. It spiked higher where there was a lot of enthusiasm initially, but there was a lot of sideways movement. But that actually, the sideways movement, along with the decline of the CCI, could cause a bit of a selling, okay? However, if you notice, that's why I'm saying you need always to combine it with price action analysis or another momentum indicator. Because this decline of CCI could scare you a bit, then you could start closing the long position. However, if you notice the price action, even though it was consolidating, it kept posting higher lows, right? And the CCI held a steady performance above zero. So this is this requires a bit of a, I mean, you may need to be a bit careful on the consolidation, on the range, in the possibility of a range, in a ranging market. That's why in a ranging market, you need to keep an eye on the CCI and whether is consolidating as well, holding, sorry, a distance from zero, because this is an indication that bulls are still there. Now, look at what I'm trying to say. Look at this, okay, and look at these. This is a consecutive lower lows in the CCI. Here we have something flat, so this wasn't a sign of selling, right? Okay, this was, but it was still, this was a sign of selling, but if you combine it with the price action, you can see that it was a small body candles, doji candles, sideways candles. So the price action wasn't in line with the CCI. You need to have price action and your indicator in line in order to take a final decision. If they are not in line, then it means that it might be something, might be temporary, might enter in a ranging market before another attempt to the upside, and so on and so forth. So, and here, the breakout again of CCI highs, or the breakout to the upside of the latest ranging market, the exit from the ranging market, is another call for a long position. And as you can see, if someone was treated this signal as it should and didn't panic on it wasn't panic and closing position because of a correction on the CCI, a nice and a proper exit level, okay, would have been once it actually went negative, not earlier than that. Once it actually went negative. So here, okay, clear? Clear, guys, so far? Okay, let's move on with another example. Sorry. Another example for a new trend. Okay. I think that's straightforward. Okay, never mind. That's just an illustration. I should have shown that earlier, but here we are. It was in a downwards channel. Think about this line as the top of the downwards channel, okay? With CCI being above positive, but didn't manage to close. This is a 100, and this is a minus 200, but never managed to move above 100. Okay, it was persistently below 100. The only the single time that it managed to extend above 100, it was here, and in a combination with a breakout to the upside of its long-term down channel. Okay, so something like that indicates the possibility of a reversal, right? So it spiked higher, didn't manage to held above 100. We had the pause of the rally over here. So 1, 2, 3, 4 for 5 consecutive sessions. It was moving sideways without. There was a lot of indecision over here, but while there was an indecision in the price action, while we have seen indecision in the price action, we started seeing the CCI pulling back towards 100 until it managed to extend below 100, and that was a selling signal here. Okay, so it was a sign that it will continue in the same direction on the downside, basically. So another example. So here we have a stock, actually one daily chart, Apple more precisely, and again the satisfies which sentence satisfy Apple is 100 and minus 100. So what we have, oops, what's going on? You will okay. Have a question on how we could set the CCI. It's actually straightforward. Let me just show you how. Here we are under oscillators, drag and drop it. You are getting by default, as you can see, the minus 100 and 100. And if you want to have the center to have a line in the center on the zero cross, the zero line basically, you just add a horizontal line on your indicator. So come on, let me just set it to 0. Here we are. Okay, it's pretty actually straightforward, I think. Let me know if it's not. So in this example, let's get back to the example. Remember that it's an oscillator, right? We have Apple in a daily chart. As you can see on the 27, that should be somewhere between 28th, 29th of July. There was the first of all, the CCI was above, actually moved past the 100 threshold. Okay, remember above 100 threshold, it tends to be an indication of overbought condition, and it was a bit, it flattened actually above 100, as you can see over here. It flattened above 100, overbought and flat. The same stands for the actual price action. The asset actually was consolidating at 197 territory. So the overbought condition in combination with this indecision that we could see on the price action, on actually the candlesticks, indicated that we might have in the near future a reversal. Okay, but when actually we're going to have a confirmation, we're going to have a confirmation as soon as the CCI in combination with the price action with Apple stock start turning lower, and more precisely CCI to start to actually turn below 100 territory, right? So it managed to turn below 100 as soon as Apple stock declined by nearly 5%. As you can see, it started turning lower and lower until it gapped down, and the CCI, you can see that the CCI finally dipped below 100, indicating that there is a downtrend for the asset. The CCI continued extending lower and lower until it crossed minus 100 territory. That was the very, very first indication that we have entered an oversold state, but not necessarily an exit point for our possible position, let's say. Okay, an exit level will have been as soon as we see, the CCI rebounding. So it started rebounding here. Let me draw it here. Started pointing higher, away from the bottom, right? So remember that a reversal, a rebound of the CCI, if it's in the negative territory, if it's below 100, that indicates an upwards shift. And indeed, the upwards shift was seen over here when it managed to when it extended away from minus 100 and towards 0. So a possible entry point for a long position would have been here, and more precisely, to be honest, somewhere here. Okay, now, so this is a pretty simple example. Okay, you can see that this example illustrates the CCI efficiency, and hopefully it gives you it helps you understand how you can identify potential reversals in market conditions. Now let's move on. I mentioned that other than spotting a new emerging trend, it also is useful for identifying overbought and oversold conditions, and how you can use this, how you can use it for as a signal. I mean, how you can use an extreme condition on your benefit. So it's a bit tricky, this one. Okay, this one is a bit tricky. So identifying overbought and oversold levels can be a bit tricky with CCI and any other momentum oscillator. It's not only CCI. Exactly because, as I mentioned earlier, the CCI is unbounded and an unbound oscillator. It has levels, it has a range, but it's unbounded. So theoretically, there is no upside or downside limits. So that's why it makes any overbought or oversold assessment a bit, actually, subjective, not a bit, subjective. So also, we might see asset moving on the same, continue to move on the same direction, let's say higher, even though the indicator has become overbought, or lower even if the indicator becomes oversold. Because that's why I mentioned that is a bit tricky. But let's see together how you can interpret the CCI, even in situations where we have seen the CCI being and extending further to the upside in an overbought condition or in an oversold condition. So basically, the selection of overbought and oversold levels depends on the volatility, as I mentioned in the beginning of this webinar, the volatility of the asset. That's why once you drag and drop your CCI on your chart, you need to make sure that you need to go back the past performance to make sure whether the 100 or minus 100 indeed gives you nice signals on time, signals not delayed, not too early, etc. If not, you need to play with it to see whether you need to extend it to 200 or minus 100 and so on and so forth. So, for example, here it's a daily chart, and we can see that if we left the default settings, focus on the 100 and minus 100 on this area over here. Focus on this one. If we left the 100 and minus 100, the default settings, we couldn't actually spot an appropriate. Actually, we couldn't spot the right timing of a reversal. Okay, because every time, as you can see, what you should do, how you should analyze the CCI in combination with the price action is leave the default settings and go backwards and check Okay, here it retested the 100 and fell, right? Until it reached overbought territory, rebounded. Here it crossed above 100, but look at that. It crossed above 100, but it didn't reverse to the downside. Instead, it continued moving to the upside for quite some time. So that means that the barriers are not sufficient for this particular asset, that you need to extend it further to the upside. It's similar with what you do with Bollinger Bands, for example. You might need to change the standard deviation to take it higher or lower. That depends on the past performance of the asset. So test before using. So as you can notice, and you can see in this Google chart, the 200 territory was a much better, it gave us much better signals, overbought condition, oversold conditions, selling points, selling levels, selling signals and buying signals, rather than the default one was 100. You see that, and it's actually repeated. It breached, it crossed above 20, right? It topped over here and then start moving lower and lower, and that was indeed a nice reversal level. Here the same reversal in the CCI and a reversal in the actual price action, rebound of the rebound from in the price action, rebound here in the actual CCI indicator. So a sell and a buying signal, another buying signal, and so just compare the performance with the indicator signals, okay? Because guys, as we mentioned, it's not solely the zero line that can be used as an entry level. Even the rebound away from the negative territory could be used as an entry level, or the pullback from the oversold, so from the overbought territory could be used as an entry for a short position. Always test, check the past performance, make sure that it's satisfied, that you make sure that the settings that you have tried indeed satisfy the asset performance, and then take any trading decision. Now, how you can spot bullish and bearish divergence using, again, the CCI. So just a quick reminder, because I don't know how many people are new here, or what's the level of your how experienced you are. Just to highlight that divergence, by saying divergence, is actually the signal of a potential reversal. Okay, and it's an ahead of time signal. So that means that it won't happen on spot. It's just the very initial alert, let's say, for a possible change in the momentum, but it's not a confirmation of the price. Okay, so a bullish divergence occurs when the asset makes a lower low. Let's find here, like this one. This is a bullish divergence. Why? Because the price makes a lower low. However, at the exact same time period, we can see that our indicator, in this case is CCI, has formed a higher low. So they're moving on the exact opposite direction. So this is a bullish divergence, which actually shows less downside momentum. It's not a call for action. It's just something that you should put a note on, just to keep monitoring the asset until you have a confirmation of this reversal. Okay, so it's just a very prime signal, let's say. A bearish divergence on the flip side is when the asset records a higher high, such as this one. However, our indicator posts a lower high. Again, what that means, it means that this long uptrend in my soonish might be reverted soon. It's not a call for action, it's not a call to start selling. You should consider entering a short position as soon as you have a breakout of a very strong support level in combination with a bearish signal from your indicator. So in this case over here, we had a nice double bottom over here, which was broken, right? It was broken, and it was in combination. Actually, for me, this is the level to enter short, because we had a confirmed breakout of this double bottom, and the CCI extended lower. So there are two possible entry levels over here, this one and this one. So this one and this one. Two possible entry levels for a short position. An exit point, because no one asked me actually so far where the exit point, it will be as soon as we see this higher lows of our indicator. Okay, if you keep seeing lower lows of your indicator, that means that there is further steam to the downside. Another exit point will be the cross above the minus 100. This is a nice exit point as well. This one, or as soon as you see the indicator posting higher lows. But that would be the most appropriate one, to be honest, that one. Yeah, let's move on. Limitations of CCI, basically the advantages and disadvantages. Sorry. So, second. So guys, some of the advantages of using the CCI are, as we have already seen, the fact that it could be helpful for identifying trend, for detecting divergence, and for identifying overbought and oversold conditions. Some additional advantages is the fact that is quite useful in combination with other indicators for multiple trading strategies. So the CCI is generally used, not solo, never use it as a single indicator, okay? But in combination, as I said, with other indicators and price action, as I already explained in many of these examples. And this could actually, you could build with this way a quite robust trading strategy. Also, another advantage of CCI is its versatility. So the CCI, as I mentioned at the beginning of the webinar, can be adapted to various time frames. For day trading, for 1 hour trading, or for the long term, for 50 or even for monthly, weekly, and etc. So it can be adapted, and you just need to adjust it based on the volatility of how high or low the volatility of your asset is. Now, there are some limitations. There are also some disadvantages. You need to be very careful because it's a lagging indicator. So what that's supposed to mean? It means that it tends to confirm a price move after the fact. That's why I keep repeating that you need to go back, combine it with price action and another indicator in order to avoid any delay entries or exits and etc. Also, it could generate false signals if you don't check that the settings, the default settings, indeed satisfy your asset. So always, before start using it, make sure you go back backwards on the past performance of your asset and make sure that the settings are appropriate. Okay, there is a bit of a complexity in interpretation, but I think that as soon as you get familiar with CCI, it will be quite straightforward. You just need time to learn it, to practice on it, and everything will get easier. What else? It's a bit sensitive to short-term fluctuations. So for any one of you that is interested in applying it in intraday for short-term, really short-term time frames, make sure that um, uh, that make sure that at the time that you're taking the decision, there are no major data releases that could cause a lot of market noise, because CCI is sensitive to short-term fluctuation, and that's why we could see frequent changes if there is a market noise in the market. That's pretty much it. So, okay, I spent the whole session for CCI, but that was the more tricky one. So Williams percentage will be straightforward. There are just few examples. It's a much easier indicator to be interpreted. Okay, Williams range is a momentum indicator. So basically, it doesn't it's not it doesn't help you. It does help you identify the momentum, but is widely used, let's say, for identifying entry and exit points. There is a range, it's not unbounded, so there is a range from 0 to 100 to minus 100. Sorry, just a second. From 0 to minus 100. The momentum indicator, as I already mentioned, very similar with stochastic oscillator, very similar. And by default, it has a specific period, typically 14 days or 14 periods in its settings. So very straightforward. Any reading above minus 20 signals overbought conditions. Any reading below minus 80 suggests oversold. That's just pretty much it. But an overbought and oversold condition, as I already mentioned, does not mean the price will reverse. Okay, it means that the price, if it's overbought, let's say the price is near the highs, of its recent range, and an oversold means that the price is in the lower end of the recent range. So let's move on to go straight to the examples. So there are two ways in which you can use it: for identifying overbought and oversold conditions, and for momentum failure. So here is how it looks like. As I already mentioned, any move below minus 80 towards minus 100 is oversold. Any move above minus 20 is considered to be overbought, right? And then see how, let's see together how you can use it. So here we have a chart, okay, with multiple entries. It's just an easy way for you to understand how you can use it. Remember that it's a bound oscillator. What that means, it means that you have a top level and a bottom level. So any reversal away from the top level, right? Basically, which is 0 over here, 0. Any reversal away from it indicates a possible short entry, while any rebound away from a minus 100 or even a crossing above minus 80 is a possible long position. Okay. So just one more thing, just because it's very important. It's very, very important to have in mind that any, let's say, overbought reading, it doesn't necessarily mean that that is bearish. Remember what we said in CCI, in the CCI indicator as well. Assets can become overbought, but they can remain overbought during a strong uptrend. A bearish signal will be if and only if it comes down below minus 20. Okay, the same stands for the bullish a bullish indication. It is important to note that oversold readings are not necessarily bullish. So if there is a long-term downtrend, you can understand that it might remain oversold for quite some time because there is a very strong downtrend. Yeah, so let's have a look on this example, and then we will move straight to the momentum failure scenario and how you can use it for spotting momentum failure, the momentum failure. So over here, what we have, so we have the 14-day William indicator. You can see that it hits actually overbought and oversold levels on a regular basis. So the red dotted line, which I have marked over here, is every single time that it cross below minus 50. Okay, and every single green line that I've put on is every single time that they move above minus 50. So there are two possible entries in each direction. One is the crossing above minus 80, okay, which is a bullish signal, or a sustained move above minus 50 towards minus 20. So in this in this crosses, in every time it crosses above minus 50, there are many traders actually that can use it for adding to their existing position. So if someone has entered long, as soon as the asset cross above minus 80, okay, they could add to the existing position as soon as they see further move to the upside, and more precisely above and away from minus 50. Okay. The same stands for a downwards move. So an early entry signal will be as soon as we see the indicator falling below minus 20, but be careful. You need to check the slope. The slope should be quite sharp. Okay, if it's a bit flat, that it won't be an appropriate selling signal. So either that one, as long as the price action is in line with this move, as you can see over here, and we have a sharp slope, and another possible selling actually entry for a short position, it will be the move below minus 15. You can see once again how sharp the slope of the indicator is. And last but not least, before we call it a date, yes, you can use CCI for oil as well. It's all like it's across the markets, Aru. Okay. So last but not least, if you want to use Williams for spotting a momentum failure, what do we mean by momentum failure? Is the failure to move back into overbought or oversold territory. Okay, this is actually signaling a change in momentum. Sometimes a change in momentum is can foreshadow a significant price move. Okay. So the ability that the particular indicator has to move above minus 20, it shows strength, as we already mentioned. So and as soon as we see strength. So sorry, just a second. As soon as we see strength, so a move above 20, any failure to exit the minus 20 territory. So here is a failure to exit minus 20. Here is a failure to exit minus 20. There is a failure to exit minus 20. This one as well. So what that means, if we keep having subsequent failures to exit a particular level, in this case is the minus 20 territory, that means that the trend is a really strong one and it hasn't run out of steam yet. It means that the momentum remains, there is still a bullish momentum. Yeah. And the same stands for on the flip side, a failure to exit the oversold condition, as you can see in this example over here, indicates that there is a deep plunge, there is a strong selling pressure still, even though the asset has been oversold. The subsequent failure to revert, to rebound to the upside is a sign of further, is a second and a third sign and a fourth sign. So for example, here it was 4 times. So it was a second and a third and a fourth sign of weakness. Okay. The very last example before we end the session is this one, in which you can see that the asset was in a down channel, right? So remember that any exit of the channel is an indication that the trend might change, might have changed. So in this example over here, we have seen the asset exiting temporarily the channel, breaking the uptrend, the upper line of the channel. Okay, so that was a nice indication that something is changing, that we might have a new trend. And at the same time, the CCI had a sharp slope breaking the -50 level. However, this wasn't enough, okay, because we need, as I said, you need to pay, to be very careful and always try to analyze both your indicator and your price action. As we have seen, the confirmation of a further move to the upside didn't really happen. It went straight back down, entered back went back actually into the down channel. The only the confirmation that we have a new uptrend came a lot of sessions afterwards, and more precisely here. As soon as we had not only a move away from the down channel, but also a break of the previous double top, in combination with a performance of the indicator above the -50 until it managed to cross also to cross above the -20 as well. Okay, so that's why you need to be careful, because there might be some false alarms. Always combine it with breakouts of support and resistance levels, of price action analysis, and so on and so forth. So guys, that's pretty much it. We're done. That was the end. There is one more example for you to have a look once you have free time to go through the slides and study a bit the CCI and the Williams indicator. But that was pretty much it. So we have seen together the Williams R, which is a momentum oscillator, and the commodity channel index, which is as I mentioned, an oscillator, useful to for spotting new trends, overbought and oversold conditions. So they're actually, and also it's very useful across all markets or time frames. But there is the limitation. There are some limitations with CCI, and the limitations is the fact that it's a lagging indicator. Just a quick reminder regarding that. So you need to be, it should always be combined with an additional indicator and a very, very careful analysis of your price action. So that was pretty much it. I can see that there are no further questions. I've replied to Yvonne earlier. Aru as well. Thank you very much, Rodero. Guys, have a great day ahead. Take care. We have a packed agenda this week. And don't forget that today we have the Mr. Powell's testimony. And also, I think soonish, if we don't have it already, the Bank of Canada as well. Bank of Canada rate decision. ECB tomorrow, and it's an NFP week as well. So a lot of volatility is expected this week, and especially today on the very first day of the testimony of Mr. Powell. So take care, have a great day ahead, and we're gonna see you again on Friday my colleague Michalis will present a live analysis webinar for NFP. So as usual, remember that we go live discussing the NFP results, what they're supposed to mean, what they interpret, how the market reacts on the NFP, what they indicate for the US economy, and so on and so forth. So feel free to join us. Thank you. Bye-bye.